Hello everybody, welcome to TraderMerlin Show. It is your weekend edition, a day that ended, I saw some comments in here, it ended with a little bit of a positive move in the market. Actually, look, I thought that we'd have a down day today, just felt like we were due for a little bit of a reprieve, and it actually was going that way, and all of a sudden right at the last hour, here comes the Fed and whomever you want to point the fingers at for pooch in the market, just shot it back to the upside. So all in all, ended up being not that bad of a day in regards to market action. S&P actually closing positive for the day. Hello everybody, hello. Tom, Mario, Richard, Terry, Ivzy, Koja, Gary, good to have you with us as well. Brian, I don't get to see you too much in here. Good to have you with us. Big Eb, Jorge, Tomasina, of course, the regulars. So happy Friday, everybody. Cheers. Hope you had a great trading week out there. It was a couple rough days for me, but all in all, we ended up doing okay for the remainder of the week. So, have a nice little, I think I'm Angel's Envy today is the whiskey of choice. So cheers to everybody. All right, I'm going to do... I got some new technology I'm going to try to work with on my other screen over here. I'm sure it's going to fail miserably and you guys will mock me forever. That's okay. We'll do the best we can to make the best. Yeah, it is a party shirt there. It's actually too big for me, but I figured I'm in this kind of festive Hawaii mood, you know, a little tropical holiday action. And as you guys saw on the little marketing piece I put together, that's where I kind of want to be right now. I saw saying this looks like your backyard. If this is your backyard, man, I'm very envious. Big Ed, where are you located if that's your backyard? That is gorgeous. I want to move there. That is the goal, is to find a little significant other and move to a tropical island and live the rest of my days and then just enjoying it. So there you go. That's my goal. I hope everybody has their goal mapped out. I'm going to go through listener questions to start. I'm going to try to get through as many as I can. I am actually a member of several different... I'll say trading groups, but I'm not really that much of a participant. Honestly, I just watch people complain and whine about everybody else. It's rather entertaining being in there. But one gentleman posted this question, which I thought, I have the experience and capacity to answer it, and that was this one. This is from Tyrone H. on Facebook. He said, does anybody use ATR indicator? If so, can you recommend any good videos? Every video I watch on YouTube are trading Forex, so language gets confusing to me. No worries about that, Tyrone. I will do you one better and show you the basics of it and how this all works. To me, it's really important that... one second, let me open up Teams here because for some reason I have a Teams app open and it is bugging me. It's popping up messages. If you understand how ATR works, it will completely change the way that you set your stops and prevent you from making trades that are real stupid. And I've done this before, but I'm going to try to use some new technology here to make it look a little bit better. If not, I have a fallback plan, and I have a feeling we'll end up with the fallback plan anyway. So let me bring up my drawing utensils. I have some new tools. I'll go over here to, let's see, we'll go to this one over here. Oh, there it is. Let's bear with me. I'm hoping this works, everybody. So let's say, here's you. You're over here, oops, you're over here smiling, right? You got a little smiley face on. Oh, the drawing, but not too bad, right? We can just see you all sitting right there. And you're all fine and dandy. You're walking down the road. And you notice over here, there is this snarling, evil-looking, mangy dog with just jagged, sharp-ass teeth, and he is looking threatening as all hell. And you're like, man, I don't want to get near this thing, right? I don't want to get near this dog because it could bite me. And, of course, you have every right to be concerned about this little dog because he's, foaming at the mouth and everything. So your frown turns upside down a little bit, and you're a little bit freaked out. You're like, what the hell does this have to do with ATR, Merlin? Well, the good news is, this dog is tied to a leash, and let's assume that this leash is 10 feet long, okay? That's your ATR. Basically, you have to understand that at this point, you know that you could get within 10 feet of this dog, bear with my horrible graphics, 10 feet of him, and so we're in radius, so you could do 20 feet in diameter. Paint 97, damn you, Tom! No, I got a drawing pad, a Wacom drawing pad, but I'm just not a great artist with it. So the point I'm making here is, if you're doing it from a risk management perspective and you want to understand what the risk is to your position, whatever that position may be, you need to find out how long this leash is. That leash length is the ATR. And if that leash length is 20 feet or 50 feet or 100 feet, all you got to do is tell yourself what's a safe distance to be at. So if I'm over here on the left-hand side and I say, you know what, I see this dog, there's a 12-foot leash on it. You can tell because there's wear tracks. I know this is from my childhood. There was actually a dog tied to a leash. That's how I remember this story, and I feel it's very appropriate. You know that for yourself, if you go to 12 feet, the odds are very good that you're not going to get hit by that dog, right? Give him a foot or two extra outside that distance of his reach, right? So you want to go here, we're giving yourself a little bit of 2-foot breathing room, okay? Now, of course, this chain could snap at any moment and the dog could come and get you. That's just all part of the risk that you have to take of it. But the point is you are doing risk aversion by knowing how much this thing moves. So let's see. I actually did a better version because I was planning on this failing miserably for you guys, and it goes like this. So there you are walking on the road. You see this gorgeous looking, well, this is actually a Belgian Malinois, but I mean, I'm pretty sure all of you would agree. You don't want to get close to this dog. This would be just a bad idea. Those razor fangs, I ain't getting me near that dog. Might be really friendly, but not flashing those teeth. So your frown turns upside down here. And again, going back to the illustration, if you know he's on that 10-foot leash, then your risk is simply what is in that circle. If you go inside that circle, you're in danger. So if your stop loss, in this case, let's say that's a 10-point stop loss, if you know that this security that you're trading, GermanShepherd.com or whatever it is averaging 10 points on the time frame that you're looking at, and your stop loss is anything shorter than that, then your odds are your stop loss is going to be taken out. So as an astute investor, I will look at that time frame. Let's say ATR is 10 points. I'll go out here and say, okay, I'm going to put a 12-point stop loss. It doesn't mean I'm never, ever going to get hit. It simply means I'm reducing the odds of me getting hit because I'm accommodating for how much vibration or movement this specific security has. So, okay, great. Let's move on from dog examples and go to a real life example. I'll give you a couple here, and I'm going to show you from two different perspectives just because I want you to understand that there are different ways to calculate this. I'm going to just start off looking at them on a daily because it's easy to calculate with a daily, but you could switch it to a 15-minute time frame, a 5-minute time frame, whatever you want. And if you guys have some, maybe I'll throw an example at me, and I'll try to go through those on today's show. So if I go out here and let's go to, let's see, what's a good example? A good example for this would be Home Depot. So we're looking at Home Depot. You can see that today, everybody, it closed with a nice little shooting star. You guys can see that little green candle. That is a pretty decent shooting star. Now, of course, one thing that I would like to... you remember the example from my PTR days? Yes, it was pretty bad. It was equally as bad back then, but, you know, I'm trying, man. I'm trying. If you look at this candle right here, one thing I would instantly do just for myself, and this is just one of the things I like to look at, is I would instantly go and add on volume here just to see, do we have anything like outlying volume? We don't. Average volume for Home Depot has been drifting down, but it is higher than normal, but higher than it has been the last couple weeks, but certainly not anything out of the ordinary. So that's not that big of a deal. I would love to see this pattern form on climactic, really high volume. So if I take this one step further, if I start to do a real crude mapping out of this trade based off the way I would trade a shooting star, I'd put a line across the high, line across the low of that candle and say, all right, that is where I'm looking to take this trade on Home Depot. All right, so let me grab my pen so I can do the math here. I'm looking at, and I'll round up. Let's say we want to go short at anything below 270, and my stop loss is going to be 270 to 275. All right, so I've got $5 worth of risk on this one. Is that too much? Is it too little, right? What would you guys think? Would you think a $5 risk on this is going to be too much or too little? Yeah, a lot of stocks on 52-week highs, big. A lot of them. You know, we don't know. So this is I need to find out how big the leash is for this dog, which is Home Depot, on a daily basis. So since I'm on a daily chart, I'll add on ATR. And you can see right now it's trading $4.26 per day. All right. So I ask you, if I have a $5 stop loss on Home Depot and it's trading on average $4.26 per day, am I safe or am I really putting myself at risk of being stopped out? You guys get to answer that one, right? I will put a line at where $4.26 is above my entry, just so it makes it even clearer for you. Let me modify these numbers just a hair. Oops. Modify these numbers just a hair. And if I go to 270 for my entry, anything below that, if I go $4.26 above that, which was the ATR at this moment, that would be 274.26. okay? And I will make that line in red just so you know that that's the line that we're talking about with the ATR. That's the ATR number. I hope that that's red, okay? So right away, you can see pretty clearly that I'm doing myself a service by using this ATR because my stop loss is larger than its average true range. Had I done anything that's lower than that red line, like a stop loss here, I'm seriously increasing my odds of being stopped out. Yeah, and Mario, that's the key. The word should, right? There's 3 words that I hate in trading: should've, could've, and would've. I don't know if I won't get stopped out. I mean, there's nothing that will tell you that you're never going to get stopped out. But all I'm saying is, given what I know about this stock, it's moving $4.26 every day, I should be okay. Of course, you know, it could move more, it could move less, that's okay. But at least I have an understanding and know the risk that I'm facing by making that specific trade, if that makes sense. Okay, I'll talk about trend in just a minute, but let me roll through here and continue on because I want to show you, this is an example that worked. If you used the strategy that I use for shooting stars and hammers, this is actually a potential trade for you guys on Monday, right? Home Depot, I mean, yeah, it's a $5 stop loss. That's okay. Just accommodate for it with share size. All right, so let's look at a different example, one that may not pan out as smooth as the other one. AbbVie was one that I found as well. Now, if you look at this bad boy, I already have some lines drawn on here. I'm going to take the ATR off the screen because I don't want it to, I don't want you to be influenced by ATR to begin with, okay? So what I'm looking at here on AbbVie, we've had just a brutal downtrend, right? It was up over 100. Now it bounced off at 92 and is moving up just a little bit. Well, we do have a hammer formation as well, right? You have some hesitation. It's not really into a demand zone, so that doesn't help me. I was just actually running a scan for scan on hammers and shooting stars, but you know, I would prefer to see this into an area of demand. It's not there. Okay, so just take that grain of salt. Let's go and look at the numbers here. So I'm basically telling myself if it opens up somewhere in between these 2 lines, and to make it easy for the viewers out at home, I will add on a little box to make it very easy for you to see. And that is going to be right in here. If it opens up anywhere in this yellow box or even lower than that yellow box, damn it for me, then I will be considering going long on this one. Now, for those that are listening to the podcast, and thank you for those that do subscribe to the podcast, that helps me as well. The lines I'm looking at are between $93 and $91.78 are the numbers for AbbVie. Well, that's $1.22, right? $1.22. So my stop loss, technically, if I'm going to do it right, my stop loss should be a little bit below this hammer, or this bottoming tail. So let's say I go to $91.50 to keep it nice, easy numbers for us, okay? That gives me $1.50 worth of risk. And I would be comfortable taking that trade right now. All right, look at this one. Oh, sorry, Brian. Yeah, well, you know, just be careful with Home Depot. It had a pretty big shooting star today. If you guys look at this, how many of you would think, okay, that's a decent trade to take? Going long AbbVie, even though it's not a demand, you have it did not make a new low today. It has a small little hammer formation. If we get confirmation to the upside on Monday, how many of you think would that be a decent trade? You're risking $1.50 per share. You know, you could obviously control it with share size. Anybody feel like they would take this trade or go, no way, I would run to the hills, leave it alone? On paper, when I look at this picture, I would actually feel okay taking this trade. My only question now becomes, what's our target? My target would probably be somewhere right around 95.95. So I'm only looking to make $2 or $3 of profit and risking $1.50. That's a 2-to-1. That right away would already make me second guess this one. But if I'm day trading, you know, it's a little bit different. Here's where you have to take in that ATR consideration, and this is where I'm hoping that, I think his name was Tyrone, who asked the original question. Was it with Tyrone? Let me real quick, just make sure I get the gentleman's name. I'm going to go through all my examples to find it. Yeah, it was Tyrone. To go to Tyrone's question on this one, here is where ATR would help me with this one. So I'm looking at it. I got $1.50 worth of risk. I feel comfortable with it. I don't like that it's only a 2-to-1. You know, it's okay. Certainly, I would consider this hands down, no matter what, for a day trade. I would still be looking at this Monday as an intraday day trade. Yeah, no problem. But as a swing, I'm already iffy because it's only a 2-to-1 reward risk. Now, if I add on ATR here, let's go ahead and average to range. It's moving $1.76. So now all of a sudden I don't feel as confident because my stop loss should be at least $1.76 or more. So let me add take away $1.76 from 93 bucks, which was our entry. Let's see, taking a dollar, how much? $1.76 from 93 would be 91.24. So my stop loss should be at least where this red line is. So what's happening here is ATR is actually helping me determine my risk here. It's saying, given how much the security moves on a regular basis, in this example, 1 day, my stop loss might be a little bit too tight. I'm actually increasing my odds of being stopped out, right? Maybe I want to go $2, right? And that would be interesting. It might put us right at demand zones. What I'm trying to explain to Tyrone and others that don't understand ATR is it's simply a measure of how much this beast is moving in a specified period of time. Now, to kind of kill multiple birds with one stone here, if we take that off and go back a little bit, and by the way, guys, if you have questions, type it in. I'm happy to explain them. I'm kind of just going on my own. Let's say you're looking at a much bigger time frame trade. Okay, let me see if I can find some. What about? Let's just do SPY. Why not? Okay. Yeah. So let's say you can see this right now. You're coming to an overhead supply on the S&P. And I'm on a weekly here. So let's say you're a long-term investor and you're thinking, okay, I'm looking to go short on this one because you're in that area of supply. It's at all-time highs. Due for a little bit of a retracement here because it's been moving too much. Hey, thank you very much, Brian. I hope your AbbVie goes up. Thank you for the contribution. I appreciate it. Here's an example that should be pretty easy, okay? In this example, if we just do based off the range here of these two candles I have up at the top, that's your all-time high. On SPY, you're looking at about 333.50. I'm going to write them down myself. 333.50 is your entry, and your exit would be somewhere around, let's call it 339, just to keep the number, or 339, sorry, just to keep the numbers even. All right, that means I've got a $5.50 stop loss on this bad boy, at a minimum, right? So now, I don't know if that's good or bad, but let's see how much SPY is moving on a weekly basis. Because remember, the ATR should be matching the time frame that you're looking at trading. So average on ATR, it's moving $13.57 per day. You guys can see that down at the bottom. It's certainly dropping a lot. It was up over 25, but now you're drifting down here and you've got $13.57. The problem with this is I have a $5.50 stop loss. So the odds of me being stopped out are really good. Right? It almost feels like I'm going to get almost guaranteed stopped out. So let me add in that stop loss to our price chart here, which was stop loss. ATR was 13.57. I'm going to add that to 339, which would be 343.57, I think. That upper red line is the logical point for this, meaning that's where it could stop us. Their odds are good that it's going to stop us out because of how much this thing has been moving. So, yes, Gary, this is, and I wanted to do this because someone was asking me about longer term time frames, like the retirement and 401k stuff. If you're looking at the bigger picture, this obviously would be better for you to prevent you from being stopped out. That makes sense, Gary, and others? And since if you're a swing trader looking at your 401k, maybe you're looking at the weekly time frame. Let's be honest, you're probably not shorting in a 401k account. You're probably maybe just looking to get out and buy back in at a lower price, but most people aren't going to be shorting in their 401ks, etc. The only point I'm trying to make is if that's the time frame I'm looking at, if I'm looking long term like this chart here, weekly, then I want my ATR to be weekly, if that makes sense. And Domesticated Rat, thank you so much for the contribution. You guys are awesome. Making my Friday out there, everybody. Cheers to that one. Nice little frosty beverage for you. Okay, so let's go the other way on this one. Let's say you're a short-term intraday guy, and you're looking at a 5-minute chart. Let's pick something else, and I want to make sure I take ATR off. Just because one thing I do is I always do this. Oh, I did say per day. I'm sorry. That was a weekly chart, so it should have been weekly. So I'm on a 5-minute chart here, and let's say, is ATR move for both ways? Well, remember, ATR is just telling you how much it moves. Period. Up or down, right? It's just calculating the range for that specific security. So let's pick, I don't know, let's look at, how about Microsoft? Did Microsoft look any good today? Facebook Facebook was just off the charts today. Let me see, what's a good one? Oh, Ford. Forget Ford. Look how boring Ford is. How about something that's, I don't want to do Google. I don't want to do the typical ones. Nah, how about Citigroup? All right, let's do Citigroup. Hey, Chef E, thank you so much. I got paid in Canadian dollars today. Thank you, mate. Appreciate it. So let's say, this is a decent example. I'm going to do a hard right edge here. It's more challenging with intraday, guys, because you have the hard right edge to contend with, meaning we already know what happened, and I like it when we don't know what happened. Let's say you're watching this bad boy. You're expecting it to fill the gap. You've been watching it make higher lows, and you're thinking to yourself, okay, I'll buy a breakout, right? So if you're looking at this and you say, all right, I'm going to buy a breakout, maybe you're going to go breakout above 50.72, right? Just waiting for it to break it. You can pick any numbers, but I'm just using kind of numbers that I would use. And I would say, all right, my stop loss is going to be probably down here around 50.50. So I don't have a huge stop loss. It's only a 22-cent stop loss, right? So I got to figure out, is my stop loss appropriate? Just technically looking, if I was to take this trade, it looks like it would be fine because it really feels like it's building strength. I'd be more inclined to think this thing's going to be moving up at this point. So I can pull it on my ATR here. We'll go into add on that analysis. So I'm looking right now at a 22-cent stop. Average true range, add that on, and it's moving 12, no, it's not moving 12 cents. Back at that moment in time, it was moving about 10 cents. So I would feel totally confident with this stop loss on this specific security. Does that make sense, everybody? Hopefully you can see it. The lines I have on my screen would show a 22-cent stop loss, but ATR was only moving 9 cents at that moment in time. So it's really telling me your odds of being stopped out are pretty slim because it's been moving only 10 cents every 5 minutes, and you're using a 22-cent stop, you should be fine. Now, of course, we saw the chart already, and it kept on moving up. That's fine. Another thing we could be doing is you could have added in trailing stops and used ATR for that as well. But ATR for me is really most powerful in understanding how much that specific security is moving, which way it's moving, and kind of how do I want to position myself with whatever it is, whether it's Forex, whether you're talking futures, whether you're talking equities, it doesn't matter to me. ATR is just simply saying, how much is that thing moving in X period of time? 10 cents per 5-minute period on average is what Gary, and that's a good point. If you look at this one, you guys can see this blue line is changing dramatically. So if I made that trade back here where my cursor is, it was only moving 8 cents. But if I made it near the end of the day, or middle of the day, it was moving 16 cents. And early in the morning, because of the gap really, it was moving about 18 cents. So this is dynamic. It will be changing. Obviously, it changes much faster on an intraday time frame like a 5 or 15-minute chart. If you're looking at a weekly, it's not going to be that dramatic of a change. It will change, but not as dramatically as you're going to see on the shorter term time frame. So that's kind of it for ATR. If you guys want more information, let me know. Type it in the chat. I'm going to move on to other questions here, but hopefully that shed a little bit of light, especially for Tyrone, who asked that question on Facebook. Hope that helped out, my friend. And if you have any further questions, just feel free to let me know. And you guys too as well. Type it on in the chat. All right, let's look at our next question. Keep them coming here. I will go to the screens and let's see. What was the next one? This is from Scott. It's a good one too. I like this question. It's a tricky one, but Scott says, sometimes people are just stuck with mutual funds for certain reasons. Tilly had mentioned this about a week back. Could you guys talk about a little about how you might manage this type of investment? I'm not talking about picking funds, but managing the money in those funds, or managing the money a little bit. On larger time frames, would you just use moving averages or some type of indicator? So yeah, I know I'm going to start where Scott did not want me to start, which is looking at the industry itself. In hindsight, we can look at the mutual fund industry and say, what a scam, right? There were some good mutual funds out there. Most of them were junk. They were underperforming the market, and you tack on all the extra fees, and you were just basically getting robbed. So most mutual funds were a joke. They still are, let's just say, excessively priced, in my opinion. There's no need to be in mutual funds. However, like Scott points out, there might be a situation where you just don't have a choice. Normally, that's with a company 401k plan. And of course, those 401k plans are built for you to maximize your financial future, right? You take control of it. I don't think that you're forced to do it. What I mean by that is you can go to your HR department at your company and ask them if you can go self-directed. The reason that most companies don't do self-directed is because there is a little bit of a liability to them that you could lose all your money because you're now self-directing it in investments that could go counter market. Mutual funds are only long, so you've got that in your pocket. The problem is, again, the fees. Now, to Scott's question, how would you manage those? A wide variety of different things. Scott, I'm not sure if you're an Online Trading Academy graduate, but basically you could be doing a wide variety of different things. Number one would be looking at market timing principles, right? Looking for big picture, weekly, maybe even monthly supply and demand zones and saying, okay, if it gets too overextended at a supply zone, I'm going to sell out and be buying back in once it comes back down to a demand zone, which is challenging since March, right? It's just been nothing but up. So if you're not back in, it's kind of hard to find that entry point. Number one would be using market timing principles. The second one, and this is where Strategic Investor really maps out a very specific plan, which I won't go into on this show. I'm going to save that for Online Trading Academy Strategic Investor course. But there are combinations of things that you can use. Some people like to use moving averages. They can be very useful. The problem there is you have to use the strategy or use a strategy that you continually use. Most people, when they manage their investments, are constantly changing their strategy, constantly changing. It's like, okay, well, what's the point? You're not going to get any solid learning lessons or solid results if you're always changing something. So, if you're using moving averages, that's great. What are the rules? Are you saying that if it gets above its 20-period moving average, stay long, and if it drops below its 20-period, go get out? Okay, well, where do you buy back in? So if you have specific sets of rules, which, again, Strategic Investor it's what it's all about, it makes it much easier. And, again, you could use anything that you want. It's just about having rules and something to base your trades off of. And the reason I'm being so ambiguous here is it's kind of like using that open market breakout, opening range breakout. We talked about that a little bit here where, a lot of people will just say, show me the first three candles on three 5-minute candles, high, low, and then I'll trade the breakout. That's a very simple rule, but what it does, it keeps people all looking at the same thing. And there's no way to violate that. If you sit back and wait for 15 minutes, then turn on your computer and say, I'll trade if it breaks out of that range, then great, you've got a specific set of rules. So if you're looking at your 401ks, find a strategy, implement one of them. I'm not going to be going into what OTA is teaching on this program, guys. I don't want to do that, obviously. But there are a lot of different things we could be using. Moving averages are a great way to manage it. You just have to have that set of rules in place. I personally think more important to use market timing principles than to just use moving average, but it's great because you can automate things as well with regards to those moving averages or Bollinger Bands or stochastics, whatever you might be using. All right, what do I got? Do I agree with the economists and think that we're headed into a global depression? That's from Alan. It's kind of a tricky thing. A global depression? At this point, no. We have central banks just printing money up the wazoo. It's ridiculous how much money they are printing, and we're going to get more print here in the U.S. to artificially inflate the numbers. To me, I was trying to think of some, I'm a master of horrible analogies, but it's like a drug dealer who reports to the big boss, right? And the drug dealer goes to his big boss and is like, oh, sales are good. And the big boss says, hey, I want sales. I want you to move more volume, move more weight. So the drug dealer now starts getting high on his own supply. And it's not like he's getting any more customers. It's not like anything's really benefiting, but the dealer is the one who's creating all of the demand. The Fed is the same way. Right now, the Fed is simply pushing these markets up without consideration for anything other than let's move market prices up. It's not about building jobs because a high stock price doesn't mean that companies are doing better. They're just inflated because now the Fed is pumping in trillions of dollars. Actually, some of the fundamentals are showing weaker businesses. So you've got a patient who is sick and injured, but you just keep pumping them with heroin, so they're just numb to the pain, and things keep on moving to the upside. Right now, I don't know if I would say depression. I think we're headed for something huge as far as collapse. But it's not going to happen until something with the current mechanism of just print more money fails. It hasn't failed yet. We're still just printing like crazy, and nothing seems to have changed or shown any ill effects from that printing. So I think down the road, I actually thought we'd see it a little bit sooner, especially because I have a finance degree and studied economics, and to me, this is just anybody who's got an economics degree is sitting back going, oh my God, hyperinflation's right there, it's coming, oh, this is crazy. Well, yeah, I would say the same thing, but it's not happening. We're just getting equity prices shooting through the roof. I think you also have a case where most retail investors now have a gigantic FOMO, and I think that as that continues, it'll push prices up, and then the straw will break, and that was what happened back in 2000 as well, where we had the FOMO and of people missing the tech sector. So I don't know when it's going to happen. For those of you who watch the show, you know that I have been making some pretty big short bets. I've been getting beat on almost all of them. So, there's an old phrase that says the market can remain irrational longer than you can remain solvent. I will certainly remain solvent, but it's definitely took a nice chunk of my gains for the year away on the last couple of trades I made. So, I think we are headed for something big. I just hope that I am buckets deep in short positions when it finally does happen. I know one day I'll catch it. It's funny because if you look back to the trades for this year that I've made, a bulk of my profits were made in a 5-day window of time. Huge profits in 5 days based off that sell-off in February. Given back a bit of it, basically because I kept thinking we're going to have another retest of those lows, which never happened. So, let's see. Well, the U.S. isn't falling. Joseph says the U.S. is falling because of the Fed. I mean, if you look at it right now, the U.S. is turning into the darling, right? It's all of a sudden everything looks great. I mean, markets at all-time highs. Everything's except for the whole COVID issue, which we won't even talk about that calamity with regards to response times from whomever you want to point the finger at has just been kind of crazy. But yes, Chrissy says if you look at gold and silver, there is inflation. Those are typically canary in the coal mines. But I think right now, we talked about this the other day, I believe that relationship is broken. Take a peek at the dailies. You want to do daily or do weekly? Well, let's go weekly because I think weekly is just much more dramatic. Let's bring up, I'll just bring up the ETFs because it makes it easy. Here's GLD. ATR, we'll get rid of ATR. Disable. There you go. You look at this, and again, the historical perspective from an economics perspective is that this is a run to safety. Well, I would argue that it's broken because the equity markets are showing the same chart. So something's disconnected, and the bottom line is it's just trillions of dollars flooding the markets trying to find a home. Until companies no longer can service their debt with this cheap, easy money, markets will move to the upside. The Fed even stepped in and talked about buying corporate bonds. So that I thought was the next leg to drop. You guys remember the story with Bill Addis where he was really going, oh man, corporate debt's that's just the bad spot. Boom. Fed stepped in and said, we'll bail out corporate debts. Like, can we have a market that actually functions because of market efficiencies other than one that's completely manipulated by the Fed? Unfortunately, I'm fighting the Fed and it's not working. Oh, yeah, okay, I'm sorry, Joseph. The US dollar is falling because of the Fed. Got it. Yes. It absolutely is. And it's a beautiful picture, by the way. If you take a look at the dollar index, here's the Dixie. Yeah, you're right, Joseph. Sorry about that. Here is your dollar index on the weekly. That's a pretty monster sell-off here in the dollar. Now, for those, Chrissy says, I guess once they see gold at 10,000, maybe. I tell you what, if this dollar keeps falling like this, you're going to see commodity prices continue to rise. And the disconnect that I see, and we talked about this as well, is what's happening with crude oil. Crude oil just is not responding to this just colossally weak dollar. All right, let me make sure I get more listener questions here. Bear with me as I bring up those other screens as I manage trying to juggle 3 of them. Let's see. This one's a little tricky because I'm a bit different the way I do things. This is from Baldhead B. So BHB, thanks for your continued support and messages. He says, what's your suggestions on managing risk on selling put options tied to time elements on expiration date? Do you just set a percentage of your account? I'm not even going to go further here because mine's pretty simple. When I'm selling a put option, I'm basically saying, hey, I want to buy whatever security it is at a specific price point. And I will usually let those go to expiration. I know a lot of traders will actually bail out of them early. That's not me. I let them go to expiration. And only one time out of probably, 50 or so have I been executed and been put the shares. I actually thought it was going to happen to me on, what was the one that was really bad? United Airlines. United Airlines back in, I want to say February, March. I had sold $25 put calls and went all the way down to 17, I should have lost a lot of money out of that one, but did not. So I don't put per se a stop loss. I'll let it ride to expiration, and then if I get executed, I'll manage the trade once that happens. So unfortunately, I'm not the right one to answer that question for you, Baldhead. This one is, again, more of a market mechanism question. Merlin, can you explain how the YM, ES, and NQ get their value in the futures market? Basically, they're tracking an index, right? So these futures products are tracking an index, and each index, whether it's the S&P, NASDAQ, Dow, Russell, is calculated differently. Not going to go into all the different specifics because it's some coveted secret for some of the indexes, but they're very different structurally in how they're weighted. Some are price weighted, some are value weighted, some are portfolio weighted, so they're each calculated differently. Bottom line is, let's take the Dow Jones Industrial Average as an example. You take 30 stocks, and they have a divisor, a little multiplier number, and they take the value of all of it, they add them up, and they add this little multiplier, and that gets them to 27,000. I think right now, if you'd add up the price of all Dow stocks, my guess is, and one of you guys can probably do the math in your heads better than I can, my guess is it's probably around $4,500. I'm trying to run through some of the prices of the stocks. Be right around $4,500. So it's not the actual price of all the shares. There's a multiplier that they do. You can find out why that is or how they get that multiplier. But the same for the S&P, the NASDAQ, and the Dow. The futures markets are simply tracking that index, and then it's the expectation of what that index will be at a specific moment in time. For example, right now you're on the SPU 20. That's or ESU20, that's the S&P mini contract for September. You can go to the Z's and trade December, but it's the forecasting what those prices may be. All right, what else? And if you guys have some, let me know. Here's one that I think for those who watch Power Trading Radio in the past, you know my stance on this. Mario, who's with us today, good to see Mario, says, what's your take on IPOs as a speculative trade, and can they be traded on a normal platform like TradeStation, or is it special authorization required? That is a dangerous arena to play in. The reason I say it's a dangerous arena is, for those that haven't heard me say this before, an IPO is the summation of a colossal amount of hype, of pump and dump. People can pump and dump stocks, and they can actually get busted for it. You can go to jail for pumping and dumping stocks. If you're an institution, it's just called an IPO. So here's how it happens. So let's say that Mario's got a company. It's Mario.com. It's a new coronavirus drug. That's right, a .com with a coronavirus drug. I'm just making it up as I go along. But Mario.com is this new company. They're privately held. He just started up in his garage 6 months ago. He got some funding from the government, turned his photograph company into a drug company, and all of a sudden gets almost $1 billion in grants for it. Ridiculous stuff that's happening out there, did I tell you? And basically he says, I want to take it even further. I want to see if I can get this thing public. So what they'll do, you take Mario.com and you shop it to an investment firm like Goldman Sachs. Goldman Sachs will come in and say, okay, we're going to buy all of this shares at a specific valuation number, and that's basically going to be our company. Each share has this amount, this value, and you get to keep a certain amount, but we're going to price it at this point. What happens at that point is Goldman will now go out and create hype. They're going to do everything that they can to hype this company up to the moon, make it the next greatest thing on earth. That's their goal, is to pump it as highly as possible so that when they sell their shares, they can get more bang for their buck because they're holding now most of the shares. So let's say 3 months go by, they're on the road doing a road show trying to hype up your company. And of course some analysts come out and like, well, I don't know about this, I don't know about that, and no, I'm not really that interested. What they'll do is Goldman will go to the major players. So they'll go to their partners. They'll go to Merrill Lynch. They'll go to Morgan Stanley. They'll go to JP Morgan, Chase, and say, hey guys, would you like to buy a chunk of this? And if they do want to buy a chunk of it, then they've parlayed their risk. Remember, if they can pump this thing enough so it becomes the goose that lays the golden egg, there's no reason for them to offload any shares to anybody. The next part is they will parlay it, off-sell it to other brokerage firms. Then it goes down a little bit lower till ultimately, if this is going to be a not good-looking IPO and they can't get rid of shares, what they will do is they will now call you on the phone. Be like, hello, Mr. Mario. This is Merlin Rothfeld with ABC Investments. We have a deal for you. If they're calling you on the phone trying to pitch an IPO, hang up the phone immediately, guys. Immediately. The only reason they would sell it to you, a retail investor, is if there was nowhere left to go to dump these crappy shares on someone. Now, if you are a client of theirs that's got $50 million in their account, they may actually hook you up with an IPO beforehand. So, that begs the question, when can you get into an IPO? Most of us will not be able to get into an IPO before it goes public. If you can, that's usually a good thing, right? Because again, this hype process, this pumping it up and getting media exposure, getting Jim Cramer to talk about it, and getting the Najarian brothers on CNBC to talk. You want all the A-listers talk. You can hire 50 Cent and Kanye West to talk about your company, right? Just boost it so people who have no clue want to buy the IPO. Hype it up. Most IPOs tank right away in the first 30 days, by the way. So at that point, now begs the question. You haven't gotten it. You want to buy this because you're watching the TV and everybody is talking about Mario.com. So you put a market buy the day the IPO happens. Would TradeStation stop you from doing that? Probably not, right? They probably would not stop you from buying those shares. But remember, what are you doing? You're buying something that's going to be the most hyped issue out there because they're trying to jack price up as much as possible to make as much money as possible. So knowing all of that, you guys should know my attitude towards IPOs. Leave it alone. You want to get lucky every now and again and get a monster trade, great. But for the most part, you're just going to end up losing. IPOs tend to rip the first day or two and then sell off and drift down until 30 days later. They're usually way below where they did their IPO price, usually. So I am not a fan of IPOs. Plus, you have no technical track record, right? If you got one candle to choose from, how do you find out where your supply and demand zones are? You don't. Also, I would wait 3 months. Wait until the vesting period is over. Usually there's a holding period where the insiders who were connected way before, they have to wait to sell their shares. Normally that's going to be 30 or 90 days depending on how it's written in the contract, 30, 60, 90, but just wait 90 days. Wait 90 days because are you really buying this company because it's the next greatest thing on earth and it's going to be, creating coronaviruses or vaccines? No. You're buying it because you think it's going to go up in value. So wait for it to come back to a point where you can see on a chart that this would be a buy point. It's just too risky for me to be trading IPOs like that. Alan says, but retail investors account for such a small percentage of traders. It has to be big money pushing up. It is big money pushing it up. It's the big hype. There's a great video. I wonder if I could find. Actually, I learned something. You can't play videos from YouTube through a YouTube stream like this, or they'll shut you down instantly. I don't want the stream to end. There was a Saturday Night Live skit done years ago, which I thought was beautiful, and it ties right into this topic of institutions pushing it. If an institution needs to unload a position, they might be in a bad position, losing money on it, or they just have too much of something, and they want to get out. What do? They issue press releases and they make it sound like this is a great thing for you to buy. In this video that Saturday Night Live did, it was awesome. And if I can find it, I'll post the link because it's just fantastic. But basically, it's an investment banker, portfolio manager, something, standing in front of his group of investors, and he's doing, honest talk with so-and-so. And he makes a comment. He goes, "Oh yeah, well we unloaded our entire position of this company, 3 months ago." And the woman stands up. She goes, "Excuse me, but if you unloaded your entire position of stock XYZ 3 months ago, why were you telling us, your clients, to buy it?" And he goes, "Well, if you think about it, if you need to get out of a position, you have to find somebody out there to buy it. That's just common sense." And to me, that's exactly what this financial industry does. Yes, you are absolutely right, Alan. Institutions were driving the market up, but they're creating, through hype, through media, through television and newspapers and articles, they're creating hype on something. So they can use that retail investment population to be the patsy to catch their shares when they unload it. That's just common sense. So that's the way it works. And yes, the retail population is much smaller, although it's getting bigger and bigger as more people are, the single share or fractional share thing is allowing people to get in and no commissions for equities. So as you can see, the Robin Hood effect going on with many of the stocks of the day, which has been absolutely nuts. Like WeWork. Oh yeah, WeWork. That would have been a flop. Imagine if you bought WeWork right now. Oh man, not so good. Coach at Merlin, Apple going to split and everyone going crazy to buy. The question is, buying Apple shares now, it is a good idea, or should we look at the chart? And I would wait for the chart. This is you want to buy something at its all-time highs. That's what Apple was ripping today. Yeah, that's the weekly. Is it not today? Oh, actually, I had a little bit of a sell today. Let's go back to the monthly, just so we can see the bigger picture here. Let me rephrase that. Would you want to buy here? I don't. And again, Koji, if you do, or others who are thinking about buying Apple, that's fine. But look at the chart. I mean, to me, it's overextended. And I would simply I wouldn't buy it. If you wanted to buy it, which I would recommend, if you wanted to buy Apple, sell puts. Sell puts, collect premium. All right, you can go to a daily chart here and say, all right, I'll buy it at 380. I haven't looked, but I'm pretty sure you get some decent money at 380 going out 30 days on Apple. All right, let's see. I know the option chain is going to be a bit screwy right now. Let me check it out. Bear with me as I get this thing all loaded up. And again, if you guys have questions, feel free to send them on back. You guys are send them on into the chat here. Yeah, I know, Joseph. I saw that. No, I thought stimulus would be this week. Thought for sure it'd be coming this week. You know, and do we need it? Yeah, and Koja, I don't want to influence you. You know, if you felt like buying it, great. You know, you just have to have a stop loss in place. And I think we'd all agree that Apple is a little bit long in the tooth, right? Long in the tooth. So let me go to here's Apple. And what do we talk about? Yeah, you talk about the 380 puts right here, right? So if I go out to the monthly expiration, which is 13 days from now, and I look at 380s, you get 80 cents. So you're not going to make a bunch of money on if you bought one, you're going to make $80. You make $80 per contract. But you're also, probably not going to get executed because you think it's going to fall to 380. If it does, great. You get it, and you get to buy at a discount. I just think buying right now is way too risky on Apple. I'm definitely not saying that Apple is done and 444 is its all-time high or it's the highest price it'll get. No way. Apple could definitely go much higher. But remember, stocks are like distance runners. And distance runners can go, obviously, a long, long time, but they don't go a long time at full sprint. A distance runner finds a pace, a cadence that they run with. If you look at somebody like Usain Bolt, fastest man on earth, can you imagine if Usain Bolt tried to run a marathon? It ain't going to happen. I mean, he'll beat everybody to the 100 yards, maybe 200 or 300 yards. But I'll tell you what, he's not going to make it past 1,000 yards at full sprint like he does. He's done, toast, kaput. He has to fall down and take a breather. That same analogy, I would look at these equity markets and say they've gotten a little bit long in the tooth. The move is, they're on full sprint mode, right? And you can see here on Apple, it actually has had two really big aggressive moves up, but $200 back in August of last year, and now you're at 444. That's a pretty significant move. The one that, yes, Big Eb, and I brought that chart up the other day on the show, showing that their price is soaring and their profits aren't just falling. Their profits are getting sliced. I mean, they were getting absolutely ripped with regards to profits. And if you guys want to see that chart, let me bring it up here and I'll show you. It was really kind of interesting when I brought those numbers up because the way that Apple has been moving, I was really thinking, you know what? They're going to have blowout earnings or something. But let's look at AAPL. I'm just doing, this is just Yahoo Finance, and I will go to financials. I think it's other financials. Yeah, there you go. So here on the left-hand side, let me see if I can make this bigger for you guys. I know it's horrible to look at, but I know it's on the left-hand side of your, or right-hand side of your screen. This is annual. And you can see that their revenues and earnings, right? So both numbers were falling in 2019. We had no COVID issue in 2019. That was trade war stuff. But let's look at quarterly. What? You're talking a stock that's just smoking to the upside, like a 50% gain in less than 6 months. And look at their earnings. The revenue for Q4 of 2019 was over $20 billion. And now all of a sudden, you're looking at revenue, yes, their earnings was over $22 billion. For Q1, it was 11, and for Q2, it was 11. So you have Q1 and Q2 don't even equal the earnings from just Q4 alone. And the revenue numbers are appalling. I mean, they've seriously been sliced to less than 60 billion. I say appalling. Less than 60 billion. So, there's problems here. And I guess once the reality sits on, right now people are just drinking the punch, drinking the market Kool-Aid of this thing's never going to stop and the Fed's going to push it to the moon. And you got to keep playing that card, I guess. At some point, it will catch up with it, and I hope I'm short when that does happen. What does your long-term look like, Merlin? I'm diversified? No, not really. I am more targeted. So the questions for the podcasters out there is what does your long-term look like, Merlin? Are you diversified in real estate, or do you have an investment portfolio? If investments, do you swing traded? I am more of a of a swing trader. I have had some positions. I had positions in gold. I had positions in silver. I have some in crude oil. The gold and silver ones I sold, what was that, last week or 2 weeks ago? I think it was last week, losing track of time. Right now, most of my stuff is sitting in cash. And there's a reason for that. I feel like we're going to have a correction. I'm going to buy back in at a lower price in the longer term swing trade stuff. So usually I do have positions on, but I just have a hard time believing this market's going to have another 20-30% move to the upside from current levels. So I'd rather be in cash and be more prepared for buying the pullback when it does happen. Okay, I think, if I'm not mistaken, I got through all the questions today. Yeah! Whew. Surprised I made it. Let me just show you the economic calendars and earnings calendar for Monday. You guys feel free to send on in some questions, and I can do an open Q&A here as we wrap up our what'll probably be an hourly show, just because Big Eb wants me to do an hour show every day. This is the economic calendar for Monday. Not a ton of very important things going on. I mean, you see some housing starts for Canada, JOLTS job openings for the U.S., but that's pretty much it. Probably the most important thing on here, if you're trading a British pound, is that unemployment rate that comes out at 11 p.m. Monday night. So that'll be, we'll be doing the show and it'll still be after that. But they're expecting to see an increase in their unemployment rate from 3.9 to 4.2. Earnings-wise for Monday, if you're trading the MJ ETF, you're talking about drug school, Cheech, you got Canopy Growth, and you have Tilray reporting earnings, along with Duke Energy, New Age Beverage, and Occidental Petroleum are a couple of the others that report earnings on Monday. That's pretty much it. Do I think this rally towards all-time high is a huge bull trap? I do. I do think it is a bull trap, but you know what? It will keep on going up until something dramatically changes. And again, I think the only thing that could really bring this thing down would be a major miss on earnings or just the collective miss. But earnings, that was my gamble, was that earnings were going to come out really bad. Earnings have not been that bad. Shockingly, earnings have not been that bad. We are going to see more retail companies reporting in the next couple weeks, which is the weak spot. Carnival Cruise Lines and Simon Property Group. I think you have Macy's coming out next week. So, that will probably have a little bit of a pull down, but not too much. So I don't really see anything other than, I don't really see any real logical reason why the market should sell off at this point. We seem to be coming out of COVID okay, barring a couple little flare-ups here and there where the number of cases are spiking, but the number of deaths, they're not. Earnings were pretty muted. Let's see, is there any? I know Carnival Cruise Line comes out next week. Joseph says, would I short SPY here? Yes, I would short SPY. I would probably wait until Monday and go a little bit deeper into the zone. My guess is you'll probably go deeper in. Here's your SPY. Again, Tilly's Market Outlook will be out on Sunday, so you guys can get a little clearer idea. But almost map this trade out. You're at 334.57 on SPY right now. That high is 339, so you're $4.50 away from being at the highs for 2020. If you are trading it, then just put a stop loss above it. My guess is we'll probably break it. We'll probably have a rally up to that 343 mark, and then all of a sudden a pullback, kind of like a little bit of a bull trap. Thoughts on the unemployment surprises? Are you referring to today's numbers or yesterday's numbers? Because there's always numbers out there. It drives me nuts how there's so many damn numbers. But if you look at today's numbers in particular, non-farm employment change, it was 200,000 more jobs. But again, the previous number was 4.7 million. So there was a huge increase last report. This one wasn't that great. I mean, yes, it was bigger than expectations, but I don't see the non-farm employment change stoking the rally. I think that people really need to see a higher number. We had 1 month spike with a good amount of jobs, but all of a sudden it's starting to drop back down again. So I don't think it was that big of a deal. I mean, obviously the unemployment rate was better than expected. You had 10.5% was the expectation. Previous number was 11.1. We came out at 10.2. So it's still good. But guys, you're still at 10% unemployment. I mean, that's a massive number. And unless the Fed does another round of stimulus and the government extends, more money for the EDD or unemployment benefits, we'll probably start to see this start to drift down a little bit. My guess, though, is they're going to keep pumping money in. You guys know my stance, and I think that people should be going back to work or finding work any way they can, as opposed to being rewarded for not even attempting to go to work through unemployment. I told the story a few times. I have friends who are making much better money than they did on unemployment. than they were working. Crazy to me. I'm the type of person that likes to be working and earning, making money as opposed to just be giving it to me. All right, what other questions you guys have? Any last minute questions for me? Let me see. Are you trading in a Roth IRA to avoid capital gains or normal account? I can't invest anymore in the IRA just because of earnings, right? There's a cap on what you can contribute in there. But yes, I do have both. My main focus when I was younger was a Roth IRA because if you have the opportunity, I would personally go with a Roth IRA. The only challenge here, for those who don't understand what the difference is, if you go in a traditional IRA, let's say you're making $50,000 a year. If you put your money in a traditional IRA, what happens is, let's say you put in $1,000, right, a year. That $1,000 is going to be tax-free, right? It's taken out. So you're really only taxed at $59,000 worth of income. But that money, when you pull it out at retirement, whatever that retirement account is, it's taxed. And in theory, let's say you're growing your account at 8% per year, you now turn that into a couple $1 million, all of a sudden, that's going to be taxed at the full ordinary income rate. Crazy. So you have to really strategize in that situation of how you want to pull that money out of retirement if you are using a traditional IRA. If you're using a Roth, you pay taxes on it now. And then when you pull it out, it's all tax-free. So let's say, for example, I'm in both scenarios. I got them side by side, and I have accumulated $1 million. I got $1 million sitting in a traditional IRA and a Roth IRA. If you wanted to pull $1 million out at once, hey, I finally reached it. Hallelujah, I'm retiring. Yank that money out, and you pull $1 million out, you're going to be taxed at ordinary taxable income, which is, let's say, it's going to be what, close to 40%. So all of a sudden, you have $600,000 left. That hurts. If you're in a Roth IRA and you pull that $1 million out, you've got how much? $1 million. It just works better for me, and I believe the assumption is that when you're younger, you're making less money. So why not pay taxes now at a lower rate than you would later on? That's just my perspective on it. Let's see. Where's my drink? It's still there, Chris. It's almost gone. Little angel's envy. The ice cube is still there. Can you trade quickly in an IRA? Not really. No. Because an IRA is a cash account, you have a 3-day settlement normally. It's called T3. Some will actually shrink it down a little bit, but there's a period of time you have to wait by the time that you place your trade for that money to be readily available again. So you really can't trade quickly in there in your IRAs. Now, that said, could you be trading options and futures? You could trade options, you can trade futures and other things as well. Let's see. Big executive order throughout. We'll get the stimulus done. Yeah, right. And that could very well be what it is. I was actually thinking that we'd see some government action against some of these FANG stocks because, in my opinion, they are a little bit too big, a little bit too powerful out there. When you think the statistics I read showed that 35% of the world uses Facebook. That's pretty crazy. And the other one was that 40% of U.S. commerce, and I have to really check this figure because it seems just unbelievable to me, but 40% of U.S. commerce is done by one company, Amazon. That's crazy. Hey, Walter, good to have you with us. I buy what I want and run it by myself, but how can you day trade with it? You can't. I mean, you can day trade. You could buy something and then sell it, but that money won't be available for a number of days. It's T1 would be 24 hours, T2 would be 48, and then T3 would be 72 hours. That's usually T3 is the way that they work. All right, guys, that's going to do it for me. Just because Big Eb is challenging me to do a 1-hour show and it's at 59 minutes, I'm hoping I can squeeze out right underneath, but I won't because my outro will take longer than that. Anyway, hope you guys had a fantastic trading week. Next week, I've got some guests. I'm going to try to get more guests on the program just to diversify things, spruce it up a little bit. Of course, I'm taking all of your considerations and questions and sending them on in. If you have questions you would like me to answer that might be a little bit more complex and take more time, go to TraderMerlin.com. You can send in questions there. That's the easiest way to do it. Or you can put them down below the video here. Of course, it's Friday, so usually we had a light attendance, which is normal. Do me a favor, give me a thumbs up if you liked today's show. If you didn't, then let me know what was wrong with it so I can fix it. I know, probably didn't like my choice of beverage, but that's all right. All right, everybody, have a fantastic weekend. I will see you all on Monday. Take care.